we have financial markets in turmoil. Central banks are clearly racing to catch up. Do you think the pricing currently reflects risk?
Unfortunately, I think there's a fair amount more to go. We're in a secular process here that things have radically changed from where they were, let's say, pre-COVID. And you went through last year where asset prices were supported by a tremendous amount of liquidity despite deteriorating fundamentals in terms of the rapid pickup in inflation. This year, central banks are scrambling, as you're describing, to catch up with what happened last year. And there's two effects to that. There's the rising interest rate, which is being discounted across asset classes that have benefited from extremely low interest rates for so long. You're starting to see that come out of the markets. And on top of that, there's a liquidity hole that's developing. The liquidity hole is a function of, if you take last year, where did all the money come from to buy assets to keep them at high levels across all asset classes? That was a result of the Fed and banks piling into the bond market despite worse fundamentals. And that money, that 10, 11% of GDP that came from the Fed and from US banks, filtered all through financial markets, essentially sustaining assets that require new liquidity to keep their prices. Now that the new liquidity is going the opposite direction, banks are no longer buying bonds. In fact, they're likely selling them. The Fed, of course, is moving towards rolling down its balance sheet. So now we're finding out at what level the private sector by itself can support these assets. And from our calculations, it would suggest that it's much lower than the current levels.
Greg, I'm so glad you mentioned liquidity, because I'm wondering, does something have to break in these markets, whether it's from the BOJ and JGBs, whether it's in the U.S. equity market and simply getting those trades, that liquidity that you were just talking about? Does something have to break for this market to turn around?
Yeah, well, in the end, if you look at all bottoms in bear markets and in economies, the Fed has to turn, right? And so what does the Fed have to achieve to turn? The Fed has to start bringing inflation down. Now, if they're serious about their inflation target, we don't think they'll end up being that. But if they are, they're going to have to tighten enough to bring inflation that's sticky and secular because of the change in globalization, and the change in the labor corporate relationships. There's a big secular change in inflation that's likely to keep it higher than the Fed target. If they're serious about 2% inflation, they're going to have to crack the U.S. economy hard. And it's then going to take the easing to offset that, and then the recovery before you see a bottom. So that's a long process. In the end, we think the Fed will blink and choose to sustain asset prices lower than they are today, but higher than they'd go if they actually tried to target 2% inflation. So that's going to be the yin and the yang, is how much pain the Fed is, the central banks are willing to put the economy in order to achieve their inflation targets. And they're now stuck. Okay, this is so different than the last 10 years.
Let's try and quantify some of this, Greg. Where if we get, say, down, if the Fed's willing to tolerate, let's call it 3% inflation, where does that put the S&P? Can we just try and put some numbers on this in terms of where you think ultimately, how much more downside risk there is in some of these assets?
I think to get down to 3% inflation is going to require still further Fed moves, that you'd likely get short rates around 4%. Now, this is super rough, which is something in line with what's priced in. But I'd expect 10 years probably to have to go to about 4%, and equity markets to come off 20% from here. So a very deep bear market, because you don't have the support of the central bank. All of the last 4 bear markets that we've had, the central bank has stepped in very quickly because they weren't fighting inflation simultaneously. So you have to look at more of the sustained bear markets of periods where you have inflation that's sticky and a weakening economy. And that's kind of the worst possible world for financial assets. It's a world we haven't had, obviously, in 40 years. And it's likely the sustained world that we're in.
Greg, you mentioned the Fed. Let's talk about the BOJ. That decision coming overnight. Some people saying perhaps this is the moment that the JGB market breaks. A popular trade right now seems to be shorting JGBs. Your take on that trade, is it something you advise?
Well, it's not. It's a very difficult situation. All central banks are in a difficult situation. The BOJ is in a unique one in the sense that they're trying to hold a peg. The markets obviously don't think they can hold. They're forced to print a lot of money to offset the market move. Now, if you look at the conditions in Japan, they have the ammunition to do this if they choose to. They can print money to buy those bonds. Speculators are small relative to the BOJ's firepower. Inflation in Japan is still low. So they definitely have a different set of conditions than if you think about the US or Europe. And I think the central bank is intending to do it, and that they're unlikely to be forced out by speculators. And again, this is not like a currency peg where you run out of dollars. They have plenty of yen to maintain the interest rate they want. So really the big question is, will inflation turn enough to change BOJ policy in a significant way? That's a real debate within Bridgewater. A lot of people have different views on that. I personally am concerned that global inflation will creep into Japan. The BOJ will be forced to move, but I'm pretty confident they'll move on their own timeline and that they won't be bullied into this move, and they have plenty of firepower to prevent it.
Okay, so just in terms of positioning at Bridgewater, it sounds like you're still having a fairly active debate on this. Have you positioned for such a move? Are you short JGBs yet? We've got a big meeting coming up tomorrow. Give me a sense of the timeline that you're thinking about and how you position around that timeline.
Well, I won't get into our positionings. I think the bigger things in the world to be positioned for is the fact that the markets still haven't come to grips with how deep an economic slowdown we're about to get into, how difficult it is going to be as this liquidity hole continues, and that money that private sector is going to have to sell assets to buy different kinds of assets, and that problem's probably the biggest macro thing going on. In terms of Japan, I'd say we often want to do, we want to be balanced to the two situations. They might break that peg. They might feel the need to break the JGB peg, and that has a certain set of reactions. And then if they don't break the peg and they print money in order to sustain it, you'll have a totally different set of reactions. So we try to create a balanced portfolio to those two things. There's certainly a lot of pressure in Japan. That pressure could leak out in terms of a lot of printed money to hold the interest rates way lower than market interest rates across the world, which has one set of results, and another set of results is they give up and they let rates go. And so if you can have a balanced mix of those things that could do well given that pressure, that's how we try to structure a view on Japan.
Greg, there's a headline on the Bloomberg right now. Bridgewater builds $5.7 billion bet against European stocks. There's names like ASML and Total on the list. We've been through some of the filings to take a look at what you guys are up to. Can you just talk to me about the logic behind that position? What is the objective in being so short Europe right now? Well,
I'm not going to comment on individual positions. We have positions all over the world, and a lot of times they're hedged in different ways. So the press reports are often misleading. But the basic picture that if you take Europe and the U.S. of this really deepening stagflation environment, this rightfully move away from quantitative easing, but assets have been suspended and in suspended animation relative to the fundamentals because of the constant flow of liquidity from central banks. That has all changed. And that the adjustment that feels abrupt is small relative to how much assets have rallied compared to the cash flows over the last decade due to quantitative easing. So if you think that cash flows need to get in line roughly with the cash flows that support them, and that they're not going to be supported by ongoing central bank purchases, you still have very big move in financial assets in Europe and in the US. And that's what we, that's what we see, and our positions are essentially to protect ourselves from that type of environment, diversified across many countries in a lot of different markets.
That protection that I think a lot of hedge funds and investors across the board are looking for, specifically in the dollar here. Interest rate differentials, a haven bid, a trade story as well. I have to ask, though, what turns that dollar strength story around, in your opinion?
Yeah, well, we think you're in kind of a dollar blow-off phase here. The U.S. dollar is quite vulnerable on a secular basis because the current valuation is extremely high. The reason the money is being attracted is essentially short-term flows associated with that interest rate differential. When the economy does crack in the U.S. and the Fed pivots, maybe 18 months from now or so, when the Fed will be able to pivot, we think you're going to be in for a long bear market in bonds. But as long as there's a debt crunch to a certain degree and a liquidity story, the U.S. will attract a lot of capital. Now, given the degree of the current account balance in the U.S., the dollar needs a tremendous amount of capital. So even a slight change in the amount of capital the U.S. is able to attract will lead to a decline in the dollar. So right now, there's still short-term pressures bullish on the dollar, but the longer-term pressures are quite bearish. And we think you're in for a secular bear market in the dollar once you get past the speed of the Fed, the current speed of the Fed tightening.
Greg, talking of money, is cash still trash?
Well, on a secular basis, we think so. I mean, this is really the big question for the central bank. What are they going to choose, right? So this year, obviously, cash has been one of the best assets. And we've been positioned for that because cash is trash, but bonds are trash and equities are trash. So relative to goods, cash has been very bad. Relative to other financial assets, cash has been quite good because of the dynamics that I've described. And on an ongoing basis, I think you still have that. And the question of how good cash will be relative to other financial assets really comes down to what central banks try to target. If they actually target their inflation targets, then their cash is going to be particularly attractive. They've got to really cut the money supply in order to achieve that. They've really got to drive cash up relative to everything else. So that's one possible world. Another possible world is they accept that this secular situation, the 2% inflation target, is too painful. They allow for a higher inflation target. Asset prices go down in real terms, but not as much in nominal terms. And that's another choice that they have. And of course, in that world, cash will be more trashy than in the world that they actually do what's necessary to move back to those inflation targets.